All right, let's talk about something that pretty much every business owner in Canada runs into at some point. What happens, tax-wise, when you sell off that last piece of depreciable property? That last company truck, that old piece of equipment, whatever it might be. Turns out the Canadian tax system has some really specific rules that can either give you a nice deduction or add to your income. So let's dive in.
Okay, so let's get right to it.
So let's put you right in the driver's seat. Picture this. You've been running your business for a few years and you finally sell the last truck in your fleet. It's gone. Then you go look at your books and you see there's still a number sitting there under that asset class. So, what does that number actually mean when the taxman comes knocking? Is it good news or is it bad news? Well, that's exactly what we're here to figure out. When that final asset is off the books, you're looking at one of two possible outcomes. And trust me, these aren't just some boring accounting terms, they hit your wallet directly. We're talking about something called a terminal loss, and its exact opposite, a recapture. First up, let's talk about the good news scenario, a terminal loss. Here's the deal, straight from tax tips. If you've sold off every single asset in one of your tax categories, what the CRA calls a CCA class, like all your company cars or all your office computers, and there's still a positive balance left on the books, well, you get to write that whole balance off. Boom. It's a terminal loss because it's the end of the line for that asset class. Now for the other side of the coin, recapture. This is what happens when you sell that last asset and, whoops, the balance for that class actually goes negative. The way the government sees it, that negative number means you've basically claimed too much depreciation over the years. So they recapture that extra benefit by making you add that amount back into your income for the year. Yeah, not quite as fun. So let's just boil this all down, because this is really the key. A terminal loss basically means you were too conservative with your depreciation claims in the past. Your capital cost allowance, or CCA, was less than what the asset actually lost in value. So the tax system says, hey, okay, you can catch up now with this final deduction. But a recapture, that means you were maybe a bit too enthusiastic. You claimed too much CCA over the years, and now it's time to pay some of that back by adding it to your income. Simple as that. Okay, theory is one thing, but let's make this real. We're going to crunch some numbers. First, we'll walk through a terminal loss. That's the scenario where you end up getting a nice little tax deduction. Every single time, this whole calculation starts with one magic number, the undepreciated capital cost, or UCC. The easiest way to think about UCC is it's just the leftover value of your assets for tax purposes, after all the depreciation you've already claimed over the years. So for our example, let's just say the UCC for your company's equipment class is sitting at a nice round $6,000. That's our starting line.
All right, it's time to upgrade, so you sell that last piece of equipment. Now, how much money you get for it, that is the number that changes everything.
In this first scenario, let's say you sell it for $4,000. So you can see right away that's less than the $6,000 UCC we started with on the books. Okay, let's do the math, and don't worry, it's super straightforward. You take your starting UCC of $6,000. You subtract the $4,000 you got from the sale, and what are you left with? A positive balance of $2,000. And there you have it. That remaining $2,000, that is a terminal loss. And the best part? You get to deduct that entire amount from your income for the year, which directly lowers your taxable income. Always a good thing. All right, now let's flip the script. What happens if you get a really good price for that same equipment, more than what it's worth on your books? Well, welcome to the world of recapture. Okay, let's hit the reset button. The starting point is exactly the same. Your undepreciated capital cost is still $6,000. The only thing we're going to change this time around is the selling price. This time, you get a fantastic price for it. You managed to sell that last asset for $9,000, which is significantly more than the $6,000 UCC. So let's run the numbers again. We start with that same $6,000 UCC, but this time we subtract the much higher sale price of $9,000. This leaves us with a negative balance of $3,000. That negative $3,000, that's what the CRA calls a recapture. And instead of a deduction, this is an income inclusion. It's a fancy way of saying you have to add this full $3,000 to your business income for the year, which means you're going to be paying tax on it. Okay, so we have these two numbers, a $2,000 loss or a $3,000 recapture. But what does that actually do to your final tax bill? Let's connect this to your year-end income and see the real-world impact. Let's just assume for a minute that your business had a net income of $10,000 for the year, just based on your regular standard accounting. We'll use this as our baseline before we make any of these special tax adjustments. Okay, check this out. Here's where the rubber meets the road. We start with our 10 grand in net income. We take our normal CCA deduction for other assets, let's say 500 bucks. Now look at the two paths. In the terminal loss scenario, we get to subtract another $2,000, bringing our taxable income way down. But in the recapture scenario, we have to add $3,000, which significantly increases our taxable income. You can see the dramatic swing this one sale can create. All right, we've covered a lot of ground, from the definitions to the number crunching to the bottom line impact. Let's just step back and summarize the absolute must-know points from all this.
So, here are the three crucial takeaways. 1. Terminal loss is your friend. It's a deduction. It lowers your taxable income. 2. Recapture is not your friend. It's an income inclusion. It increases your taxable income. And 3, and this one is so important, these rules only apply when you sell the very last asset in a given class. If you still have other assets in that category, you just adjust the UCC balance and carry on as usual.
And that leaves us with one final thought to chew on. If selling an asset can trigger a big deduction or a big income inclusion, it really raises a strategic question, doesn't it? Could you time the sale of your final asset to a year with higher or lower income to make a big difference to your overall tax bill? It's definitely something to think about as you plan your business's future. Thanks for tuning in.